Welcome to another weekly macro themes walkthrough. So what we're going to do in this video is just look at one of the topics, because I don't want to give it all away. This is the report that goes to clients, but I did want to take you through some of the charts in here and give you a bit of a sense and feel for what the report actually looks like. So this is page 1 of it, simply showing the 5 different topics. Each week we look at 5 topics. And this week we looked at, and this is from a couple of weeks ago, looked at the PMI data, looked at the SLOOS, or the Senior Loan Officer Opinion Survey, and that's the one that we're going to be looking at today. The Economic Policy Uncertainty Index, EM versus DM, DuPont Return on Equity Breakdown. That was quite an interesting one. Very rich insights in that one. And a bit on Japanese equity at the end there. So let's get straight into this one here. The Senior Loan Officer Opinion Survey. This is from the Fed. They survey a bunch of loan officers at banks and really they gauge a couple of things really. It's just about whether they're tightening credit standards, whether they're, or easing, what they're seeing in terms of demand, and also what they're doing in terms of pricing of loans versus their cost of funding. And keep that last one in mind because we'll be coming back to that. And yes, we'll quickly look at the bottom line. The latest data point to, and this comes out quarterly, point to likely ongoing loan growth, sound economic backdrop, and supportive backdrop for equities risk assets. So let's jump into those. First one here is really looking at the loan growth situation. So some viewers probably recall that earlier this year there was a lot of angst or worry about the slowdown in loan growth. Of course, we were looking at this chart here and not worried at all about that, and telling clients very much that story because if anything, that slowdown was actually to be expected. And likewise, a reacceleration is also to be expected. And what that chart is showing is basically whether they're tightening or easing standards for commercial and industrial. And, they did actually go for this period of tightening. It's inverted, and then it's come back. So expect loan growth to accelerate above 5% in sort of the next 6 to 12 months. Possibly as fast as 10%. Now, the accompanying chart here is from the National Association of Credit Managers. It is the CMI, or Credit Managers Index. And we've taken here 2 of the subcomponents. First one, new credit applications. Second one, credit extended. As you can imagine, these kind of indexes track, activity that's going to be consistent with loan growth. Pretty much at the start of the year, we saw a surge on both of these indexes. So that's another piece of evidence. And, when you're doing data analysis or economic analysis, even market analysis, you want to have confirming indicators. You want to look at other sources of data. And these are 2 different sources that tend to confirm each other on this respect. Would note that has rolled over a little bit, but they're still holding up at fairly decent levels so far. So really the picture on this one is of improving and, or rebounding and improving loan growth. The second set of charts look at that comment around the economics. So I'll actually start off on the one on the right here. So you've got the combined credit managers index in the black, and you can see there that after a period of, sort of stagnation there, you have seen a noticeable acceleration. Same thing with the combined ISM PMIs, which, they tend to mirror each other, and you'd expect that. Easier credit, or better, more when more's happening on the credit front, it tends to be helpful for the real economy. And when the real economy is going well, it makes life easier for creditors. And, that index there actually tracks broader sort of credit conditions. So it actually has kind of 2 sides to it. One's, lending activity. The other side is whether credit conditions are deteriorating, so things like bankruptcies, how many have gone to collection, etc. It's quite a useful data set, really. And on the left here, you've got credit conditions for small firms. And again, we're using two different sources of data to confirm each other. The NFIB one is the Small Business Survey, and it's measuring the proportion of respondents that are saying credit is hard to get. And that's in the blue line, and you can see there that it's at very low levels, pretty much the lowest since, way back then at the start of that big credit boom. And likewise, the Loan Officer Survey is showing, after a bit of contraction, that standards are easing up again. And if credit conditions are good for the small firms, that's a pretty good sign for the rest of the economy because, it's still the small businesses that drive a lot of growth, a lot of employment growth particular. And also are quite tied up with the consumer because, small businesses are often, fairly small and they're pretty linked to the home income, etc. So overall, the information that you're getting out of these credit conditions surveys are consistent with fairly good economic conditions. And certainly no warning signs there at this stage. And on the topic of warning signs, so the last one that we'll look at here, I talk about this one on the left as a bit of a bear market warning indicator. So that's the net change in credit standards for large and medium firms, commercial and industrial. And the line there is whether it's net tightening or net easing. When it goes below the line, it's net tightening. And you can see there that at the top of the market, just before the crisis, you actually saw credit standards begin to tighten. And that actually continued a trend that you saw up to that point and, tightened progressively, aggressively as the bear market and crisis unfolded. And by the same token, it gave the all clear when it turned back up. It also worked in this manner at the top of the dot-com boom. So this really is something that you need to have front of mind. It's one of the key indicators that we watch, one that we, very much staying on top of for our clients. And you can see that you actually had a bit of a yellow light, or, if you think about traffic lights, a bit of a yellow light or orange light there. It didn't quite go as aggressively red as it had sort of in other times, but, I like to think of this period here as a bit of a near miss because, if you look at the global economy for that time, we actually came very close to a recession at that point, which would have, if you think about what makes a bear market, it's either a recession or a crisis. And we got very close to that, but it got averted for a number of reasons. China's easing and European Central Bank easing were a major driver of that. Anyway, it's saying all clear at the moment. And the other one here, just for closing off, is the high yield credit spreads versus the change in spread versus cost of funding. You'd expect these two to move roughly in line because they're actually measuring fairly similar things. But when you see a divergence there, or you see that line actually cross above zero, that tends to make you, increasingly bearish on credit. And certainly this is one reason that you might be a little bit, less optimistic on high yield credit. But, the thing that sort of stopped me from getting, going full bear on this one is that it never actually got above that zero line. So because it's the amount of banks net increasing their spread versus cost of funding, it actually means that they're still, they're net decreasing, but decreasing at a lower rate. Versus if they go above the line, they're net increasing. So really, the message for that one is note the divergence, but don't, get too concerned about it. You need to look at other indicators, and we've got about a dozen different indicators we look at credit, and they're all fairly mixed, but there's a couple there that say, it's not game over yet, even though things are fairly stretched. So I'll leave it at that point. Fairly quite an upbeat sort of good news story there. Look, if you want to get a copy of this report, or if you're interested in taking a trial, be sure to get in contact. You can do that through the website. We've got the website there, topdowncharts.com. We'll put the link in the video as well. And otherwise, if you've got any comments, questions, please do put them on the YouTube page, and be sure to subscribe to the channel. If you like this video, then you'll probably like the other stuff that we're doing there. And that's it for now.